Financial reporting mechanics. Here are the sections that we will go over. Financial statements are the end products of a process for recording the business transactions of a company. This reading is targeted towards a user rather than a preparer of financial reports. As discussed in the previous reading, we need to take the perspective of a financial analyst who is essentially a user of the financial reports. Classifications of business activities. Essentially, business activities can be classified into three categories. Operating activities are activities that are part of the day-to-day business operations of the company. Examples of operating activities include sales of goods and services, the cost associated with providing goods and services, short-term assets and liabilities which are directly related to operating activities. Examples would be accounts receivable, where you are selling your goods and services and not receiving cash immediately. The asset that is created is called the accounts receivable, and that is being created because of your operating activity. In parentheses, we identify the accounting elements associated with these activities. Sales of goods and services corresponds to revenue. The cost associated with selling corresponds to expense denoted by X, and assets and liabilities are denoted by A and L. The second major category is investing activities. These are activities associated with acquisition and disposal of long-term assets. Examples include the purchase or sale of property, plant and equipment, or the purchase or sale of other entities' equity and debt instrument. This means that if you are company X and you make an investment in company Y by buying shares of company Y or by investing in a bond issued by company Y, then this is shown as an investment. The third category is financing activities. These are activities related to obtaining or repaying capital. There are two broad ways in which a company can finance itself, either through debt or equity. The issuance or repurchase of a company's own preferred or common stock would be an example of a financing activity, and the accounting element here is E for owner's equity. Notice that when we repurchase our own stock, that is a financing activity, versus purchasing the stock of another company is classified as a investing activity. The issuance or repayment of debt is also a financing activity, and the accounting element is L or liabilities, and dividend payments are also considered financing activity because this represents the flow of funds from the company to the shareholders. Accounts and financial statements. We have talked about the five major accounting elements: assets, liabilities, owner's equity, revenue, and expenses. The assets are the economic resources of the company. Liabilities are the creditor's claims on the resources of a company, or you can think of liabilities as a future obligation. Owner's equity is the residual claim on those resources. So as we'll see later, owner's equity is equal to the assets minus the liabilities. Revenues are inflows of economic resources. So when a company sells goods and services, the money that flows in is revenue. Expenses are outflows of economic resources, or even an increase in liability is considered an expense. Accounts are subclassification within financial statement elements. So we've talked about the five financial statement elements. On this slide, we will talk about accounts, which are subclassifications. Accounts are individual records of increases and decreases in a specific asset, liability, component of owner's equity, revenue, or expense. Let us take a look at some examples. So as we've discussed, assets are a financial statement element. Within assets, we can have several accounts, such as cash and cash equivalents would be an account, accounts receivable is another account, and so on. Listed in the top segment are current assets, and over here we have non-current assets. Here are examples of some accounts that fall under the liabilities category. Owner's equity is a residual interest, and here are some categories within owner's equity. Common stock par value, this would typically be the contribution made by the owners initially. Sometimes you will see the term contributed capital. This is the amount that the owners contribute when they start the business. Additional paid in capital is the additional amount of money that owners might contribute later. Retained earnings, when a company generates profits and reinvests those profits into the company itself, that amount is called retained earnings. Other comprehensive income is a slightly more complicated concept, and we will discuss this later. Revenue. Under revenue, we can have revenue, sales, gains, investment income. Essentially, this is a flow of economic benefit to the company. And here are examples of expense-related accounts. Let us now talk about accounting equations. The most basic accounting equation is shown right here. Assets equal liability plus equity, and this is illustrated through a very simple balance sheet. The balance sheet of company XYX on 1st January 2001, assets 1000, and that equals the liabilities plus equity. Let's say that this equity of 600 is the contributed capital. So the person who set up this company contributed 600, borrowed 400, and purchased assets worth 1000. This is the income statement for 2000 for the full period. Let's say that the company generated revenue worth 300, expenses were 100, so net income is 200. The net income is revenue minus expenses. A company can do two things with net income. Either the company can pay money out as dividend, or the money can be reinvested. This reinvested amount is also called retained earnings. So our retained earnings for 2001 in this example equal 180. And I will put this out over here because many people get confused about this. The net income is equal to the dividend plus the retained earnings for the year 2001 in this particular case. Notice the net income of 200 is the dividend of 20 plus the retained earnings of 180. Given this income statement, what does the balance sheet look like at the end of the year? The answer is right here. Notice that the equity has gone up by 180. So from 600, the equity has gone up to 780. This is because the equity is equal to our initial contributed capital of 600 plus the retained earnings of 180. That gives us 780. The assets have also gone up by 180 because our liabilities are the same. You can think of this 180 reinvested as adding to the cash balance. So our assets go up by 180. Another equation that is useful is shown right here. Assets can be computed as follows. Liability, which is 400, plus the contributed capital, which in our example is 600, the beginning retained earnings. At the start of the year, 1st January 2001, the retained earnings was 0, so we have nothing here. And then revenue, which is 300, minus expenses, which is 100, minus the dividends, 20. Notice that this amount here, revenue minus expense minus dividend, is simply the retained earnings of 180 for the year 2001. This expression will also give us an answer of 1180 for our assets. Continuing with that same example, we now have the balance sheet on 1 January that looks like this. Assets 1180, liabilities 400, equity 780. The income statement for 2002 is the same, and we've done that for simplicity, and assume that as in the previous year, we pay out a dividend of 20 and reinvest 180. The question now is that assuming liabilities remain unchanged, what is the value of assets and equity at the end of the year? Through this example and through the previous one, I hope you recognize that the reinvestment amount or the retained earnings is what connects the balance sheet to the income statement to the balance sheet at the end of the period. The reinvested amount is 180. This means that our equity again is going up by 180. So the value of equity at the end of the year will be 780 plus 180. And since the liabilities are staying the same, the liabilities are still 400. The assets will be 1180 plus 180. Let us now take a look at the accounting process. Accountants must record business transactions such that periodic financial statements can be prepared. Let's consider a small business. John started a small trading business. The table below shows the business activities and the corresponding accounting treatment. Actually, you need to come up with the accounting treatment, and in a few seconds I will display the correct answer. John capitalized the business with an initial deposit of 600. You need to come up with the accounting entries. Then John borrowed 400 and he bought inventory for 500. Here is what you should come up with. John contributed 600 to the business. So cash goes up by 600 and contributed capital, which is equity, goes up by 600. Note that with all these expressions, the basic accounting equation needs to hold true. In this scenario, the assets go up by 600 and the contributed capital, which is equity, goes up by 600, so the accounting equation balances. Then John borrows 400. Here cash goes up by 400, which is an asset, and debt, which is a liability, goes up by 400. So again we have the accounting equation balancing. And then John buys inventory for 500. Here cash goes down and inventory, which is another asset, goes up. So again the accounting equation remains in balance. What does the balance sheet look like at the end of 3rd January? Notice that we can take this accounting treatment and use the information provided here to create a balance sheet. Let's look at our assets. The assets that we have talked about here are cash and inventory. So let's look at what happens to cash. Cash up by 600, then up by 400, that's 1000, and then down by 500. So cash at the end of 3rd January is 500. Inventory up by 500, so our inventory amount is 500. Total assets 1000. Contributed capital or equity, that is 600, and debt is 400, that's a liability. Notice that debt and equity also add up to 1000. John sells his inventory on 20th January for 500. This was $500 worth of inventory. So what are the accounting transactions for that? Plus he pays rent. You need to show the accounting transaction for this also. Here are the answers. When he sells inventory for 700, cash goes up by 700. And since this is revenue, the revenue account also goes up by 700. The revenue connects directly with equity. When revenue goes up, that means equity is up. We also need to show inventory and cost of goods sold. Inventory goes down by 500 because that is what we are selling, and the cost of goods sold, which is an expense, goes up by 500. On 30th January, he pays the rent expense of 200. So cash, which is an asset, goes down. Rent expense goes up by 200. Notice that for every business transaction, we have two accounting entries. That's why this is called the double entry accounting system. You need to now show the income statement and balance sheet for 31st January. The income statement obviously is for the full month of January. On the income statement, we first show our revenue, which is 700. The cost of goods sold, which is the 500 worth of inventory. So cost of goods sold is 500 and your rent expense is 200. So in this simple example, the net income is 0. There obviously will not be any retained earnings or dividends in this simple example. What does the balance sheet look like? At the start of the month, we had 500 in cash and 500 in inventory, but at the end of the month, we have cash worth 1000. The reason is we sold 500 inventory for 700 in cash, and then we paid out rent worth 200. So that means 500 cash added to the original 500 gives us cash of 1000. The liability or debt will remain the same, which was 400. And since we don't have any retained earnings, equity remains the same at 600. So notice that no profit was made in this month and no other money was contributed or taken away from the business. Hence, the equity remains the same. Through these examples, we have demonstrated the link between the balance sheet and the income statement. The cash flow statement can be created using the income statement and the balance sheet. This will be covered later in the course. Accruals and valuation adjustments. Accrual accounting requires that revenue be recorded when earned and expenses be recorded when incurred, irrespective of when related cash movements occur. In other words, accrual-based entries need to be made when there is a difference between the movement of cash and the recording of a particular revenue or expense transaction. So there are two possible scenarios. One is where cash movement happens prior to accounting recognition, and the other scenario is where cash movement happens after accounting recognition. Let's go back to John's simple trading business. Let us say that in the month of February, John receives an order and the customer pays him $100 cash for a shipment that will happen in the next month. So how must this be recorded? $100 cash has been received. That's an asset. So cash goes up. But the product has not been delivered. So clearly revenue cannot be booked. What needs to happen instead is we create a liability called unearned revenue, and this liability amount also goes up by 100. This is a liability because John is under obligation to fulfill this order next month. Next month, when the order is fulfilled, then adjusting entry will be made where the unearned revenue is reduced and revenue, which essentially impacts equity, is increased. Notice that our accounting equation balances because we have assets equals liabilities plus equity. With our initial entry, the assets go up and unearned revenue, which is a liability, goes up. The adjusting entry involves reducing the liability and increasing equity. We can also have a prepaid expense situation. Let's say that in February, John pays rent on the 1st. This is rent for the entire month. So when the cash payment is made, cash goes down by 100, so that's an asset. But the expense has not been incurred yet because the expense will be incurred over the full month. So we record cash down, so asset down 100, and we create an account called a prepaid expense. This is also a asset. Prepaid expense goes up. So notice we have one asset coming down and another asset going up. At the end of the month, when the expense has actually been incurred, then we reduce the prepaid expense and increase our X or rent expense account. Increase in rent expense is actually the same as a reduction in equity. So equity down, asset down, again our accounting equation balances. Moving now to the other scenario where cash movement happens after accounting recognition. Here you can have a situation called unbilled or accrued revenue. Let's say John makes a sale where he delivers the product and he will receive money next month. Here he creates an entry called accounts receivable. Since he has shipped the product and he knows he will get money next month, he can record revenue. So revenue goes up and accounts receivable, which is an asset, also goes up. Notice he's not getting cash, so cash doesn't go up, but he has a receivable, which is an asset, that goes up. Next month or next period, when he gets the money, then accounts receivable comes down, so asset down, and cash, which is another asset, goes up. So again, notice that our accounting equation balances. Accrued expenses, this is where John incurs the expense over a given period. So for example, let's say that he did not pay his employee for the month of Feb, but the employee worked throughout the month, so John owes the employee some money. The expense has been accrued and it needs to be recorded. So the initial entry would be to record the expense. So there would be a wage expense which goes up, and then the liability would be a wage payable or a salary payable, which also goes up. Next month, when John makes the payment, then the wage payable will come down and cash, which is an asset, will also come down. So you need to remember these four items: unearned revenue, unbilled or accrued revenue, prepaid expense, and accrued expense. If the cash movement happens at the same time as recognizing revenue or incurring an expense, then these accounts do not need to be created. Accrual entries allocate revenues and expenses into appropriate accounting periods. And just to illustrate this point, let's say we have 3 accounting periods, 1, 2, and 3. Let's say that John buys inventory in period 1 and he makes a payment. So cash out in period 1. He makes the sale in period 2, but this is a credit sale, so he doesn't get any money. He books revenue but receives money in the next period. So the money that he gets is in period 3. If we were to use a cash-based accounting system, then our profit and loss statement would look a little strange, because in the first month we will have a big loss, money out. It would seem like nothing happened in the second period, and in the third period there would be a large amount of money in. So this would seem a little strange because the action is happening in the second period, but nothing is being recorded there. Accrual-based accounting helps address this issue. With accrual-based accounting, we recognize the revenue in the second period because that's when the product was sold, and the expense is also recognized in the second period because that is when the product was sold. And the way this happens is as follows. In the first period, when the inventory is purchased, we do not show a expense on the income statement, but what we do is show inventory as an asset on the balance sheet. In the second period, when the inventory is actually sold, that's where we reduce or remove the inventory from the balance sheet and show it as an expense, the cost of goods sold expense. And because the sale is happening in the second period, we actually show the revenue in the second period, even though the cash is received in the third period. So by showing the expense and revenue in the second period, we have a meaningful description of what is happening. The cash then is received in the third period, at which point the accounts receivable comes down and cash goes up. But notice that because of accrual accounting, we can show the revenue and expense in the second period. Valuation adjustments are made to a company's assets or liabilities so that accounting records reflect current market value rather than historical cost. This will be covered in detail later, but just a very simple example. Let's say that in period 1 we bought inventory worth 100, and then for some reason the market value of this inventory came down substantially. According to financial accounting rules, companies are required to then write down the inventory. So let's say the market value is down to 60. This writing down from 100 to 60 is called a valuation adjustment. Here is a really basic accounting system. Step 1 is to record journal entries. Here the business transactions are recorded chronologically, and we have seen this earlier. We talked about a situation where John capitalized his business, so that was on 1st January, where equity went up and cash went up. Then he did some transactions on 2nd January and so on. Journal entries are entries which are made in chronological order. So the first one is recorded first, second is recorded second, and so on. In the accounting system, they are recorded based on debits and credits, but as financial analysts, we don't really need to worry about debits and credits. The curriculum makes a brief remark and points out that it does not really use this terminology, because in the real world, the interpretation of debit and credit is different from the accounting interpretation, which creates some confusion. So by and large, we will avoid this terminology. Journal entries are then categorized or organized or sorted by account in the general ledger. So all transactions related to cash will be shown in the cash account, transactions related to inventory will be shown in the inventory account, and so on. The general ledger is then used to create the trial balance. Here account balances at a particular point in time are shown. So you might have the account balance on 31st January, and if we are talking about the cash account, then we would only show the cash balance on 31st January. The same is done for all accounts. In case adjustments are needed, that is done over here, and then we have a adjusted trial balance. The adjusted trial balance is then used to create the financial statements. And as you can see, if our financial statements are being created on 31st January, then we can simply take the account information from here. So the cash balance, inventory balance, property, plant and equipment balance, and so on to create our financial statements. Using financial statements in security analysis. This picture has been reproduced from the earlier reading. You are a financial analyst. How and where do you use financial statements? So as discussed before, once you have defined your objective, you need to collect data, and an extremely important element here is the financial reports and financial statements, among other information. But you need to take the financial reports, you need to process information in the reports, analyze and interpret information in the reports, and so on. So clearly, the use of financial statements and reports is important. However, as a financial analyst, you must recognize that a lot of judgment has been used by accountants in creating the financial reports. So they are judgments and they are estimates. And you need to understand those judgments and estimates